I'm very pleased to say today my guest host here in Brisbane is Jim Stenning, who joins us from FIG Securities. Nice to see you in your part of the world for once as well.
Welcome to Brisbane.
Thank you very much. We're looking forward to chatting with people through the week. Definitely a good chance to chat to you as well about the risk aversion that's suddenly back in vogue for markets. These kinds of events, geopolitical events, come and go. We know that from the past. How long can this one last?
Well, look, I suppose we've got to wait for it to play out. It's only just begun. One of the things about this event is that it sort of snuck up on us. It was happening and wasn't getting much attention, but all of a sudden it's front page and driving markets. And really, this is the sort of thing that we're seeing ad nausea over the last few years. Really, these sort of one-off events happening and low probability events actually becoming a reality, and that they tend to be the most destructive.
What is the concern for the market? Is it contagion? Or, I mean, obviously we mentioned the commodity prices. Oil's always front of mind when there's any disruption in the Middle East.
Yeah, look, I think that's what's in the back of everyone's minds, just the fact that it could accelerate into energy prices soaring. That's really what's driving it. I think also, interestingly, one of the things that we've been through this very calm period where people are actually, dare I say it, starting to get a little bit more confident. We're starting to see a bid come back into the US equity market and good statistics coming out of the US. And then all of a sudden this happens, and I think really what's worth noting is the price action in the VIX over the weekend.
What's suggesting that complacency to you? Where are you seeing that?
Well, I guess what I'm trying to say is we started to see it. We're seeing rallies in equity markets, in particular in the US. We're punching through, we're trying to punch through that 12,000 level. So people were starting to get a little bit more comfortable with risk assets. Really, this is another heads up.
And it's interesting, we had in the last couple of days the downgrade of Japan's debt, and it seems that people are prepared for these kind of events. People say, oh, no big deal, we kind of knew that one.
Yeah, that's a very interesting point. Yeah, I mean, this is on the converse, the flip side, what seems to be happening here is that people don't seem to be concerned. They seem to be ignoring this giant elephant in the room that is sort of these fiscal problems or these budgetary problems that the large economies have.
You mentioned obviously the worry about inflation, I suppose, in the end, which is already on the watch list for investors right around the globe. Very much in focus for us here in Australia with the RBA decision this week. What's your view on how the RBA digests the latest bout of inflation worries, I suppose?
Yeah, well, I guess, it's not an easy job, I suppose. I mean, really, I think what they have to do as a result of the floods in Queensland and elsewhere in Australia is really throw out the modelling and start again. Interestingly, I think, as this latest episode plays out with oil prices and what have you, that needs to be factored in as well. So I think it's a moving feast. It's a very difficult time for the Reserve Bank to try and forecast inflation going forward. One thing I think that was actually a very good thing was that we're actually starting from a lower base given the figures last week.
Let's actually bring in another guest for this morning, and you'll help me through the morning. You're co-hosting with me, so thanks, Jim. Jim Stenning from FIG Securities. We'll actually cross over to the NAB now in Melbourne. Dave de Garis is standing by there. Dave, good to have you on board as well. And of course, the last time the Reserve Bank board members met was December 7, which seems a world away now. What important factors, I guess, have developed in the last few months that will need to be addressed and discussed at the meeting tomorrow?
Yes, good morning, Brooke. I think, at the end of last year, the Reserve Bank, the first point to note is the Reserve Bank had got themselves to a stage of the stance of monetary policy that's probably a little bit ahead of the curve. So the market didn't expect that come February the Reserve Bank would be teetering on whether it would hike again, but the market was convinced, I think, that the Reserve Bank would leave rates on hold now for a few months, and I think that's still the situation. So looking at the situation, when they sit down tomorrow morning to talk about the inflation outlook, I think as Jim said there, fortunately they have a December quarter inflation number that was a bit lower than what they expected by around 0.25%. So some of that may be because there was more pass-through on the Australian dollar, but if that's the case, maybe retailers doing it a bit tougher, so policy is working a bit harder on the domestic economy. And then offset to that will be, the flood impacts or oil price impacts, which is obviously a lot less certain, but particularly the flood impacts on food prices in the first quarter of this year. So will that then lead to any sort of wages knock-on effect? Of course, the most important point is how large those impacts might be. And we heard from the Treasurer on Friday, Brooke, that Treasury thinks that impact would be around 0.25%, which is, I think was a lot lower than many people were expecting, certainly a lot lower than what we saw in the aftermath of Cyclone Larry back in 2006. So we get the TD CPI gauge this morning, and I think that will be quite an important clue on some of those initial impacts, Brooke.
David, I've got a question. Just with the proposed flood tax from the federal government, do you think that that's something that the RBA will have to weigh in their deliberations tomorrow?
Yes, Jim. I think one thing important for the Reserve Bank would be, whether the stance of fiscal policy has changed as a result of the floods, and whether it would be offset in the future. And I think we saw on Thursday, Friday, with the Prime Minister's speech and the Treasurers, that the additional spending, at least that the Commonwealth is proposing, is being offset by a combination of tax rises and spending cuts. So in our way of thinking, that leaves the stance of fiscal policy broadly unchanged. So the government's sort of spending more money, but it's taking money back out at approximately the same time. So that's not either adding to or subtracting from growth from our way of thinking, Jim.
Okay, but in terms of the tax taking money out of consumers' pockets, that's not going to have a shorter term effect.
Absolutely, I think it is a tax rise. It will have some impact on consumer spending, at least for a period of time. So the retail sector, which has been doing it a little bit tough, obviously, people think about, well, they've got some rise in tax from 1st of July this year, so that may affect consumer sentiment somewhat, over the next couple of months. So certainly it may have some negative effect on that part of the economy for sure.
David, when we see the Statement of Monetary Policy, which is out Friday from the RBA, will there actually be, do you think, changes to the inflation and growth forecasts?
Look, I think for this year, for 2010-11, Brooke, there will be some changes to the growth forecast downwards, but probably some offsetting growth upward revisions a little bit further out, from the reconstruction spending and the like. Now, this is a moving feast, so we're just going to have to see how things track out. So I do expect some offsets there. In net terms, they would broadly balance out, I think. And the inflation forecast, well, a lot of conjecture about that at this particular stage. Maybe we're not going to see the large increases in inflation forecasts, at least in the short term, so probably not too much from that. So there will be some sort of near-term changes, but I don't know that it's going to affect the sort of medium to longer-term outlook for inflation that much, as best we can see, which of course is where the Reserve Bank is aiming monetary policy right now.
David, do you think that in your NAB business survey out tomorrow, you'll be able to detect the impact, or maybe perhaps even the tolerance for, maybe not the levy because that's just been announced, but the tolerance for things like the inflation spike, which we're now expecting in the shorter term?
Yeah, well, this is the survey for December, Brooke, so it's a little bit before the flood impacts, so it's a little bit early to tell that from this particular survey, but it will give us, I guess, an update on what impact monetary policy is having on domestic demand, and at least on perhaps, the early, because the rain started earlier than that, on whether, confidence is affected and the like. So maybe some early clues there.
Dave, also, what are you looking out for across the rest of the week, here or globally?
Yeah, look, I think it's quite a full raft of indicators. We've got quite a lot out today, as well as that TD CPI gauge, which I think will be quite important. We've got house prices, we've got RBA credit, so both of those are important for monetary policy, and we've got other partial domestic and overseas indicators to keep an eye on, Brooke. So it's quite a lot on the plate for economists this week.
Dave de Garis, thank you so much for joining us. We much appreciate it as always. We'll chat soon.
Thanks, Brooke. Bye.
Thanks. Dave de Garis there in Melbourne. Let's go back to Jim standing with me from FIG Securities. Jim, what is your view on the extent to which the market might be underpricing risk hikes, or the risk of rate hikes at the moment? Kind of a tongue twister.
Well, I think it's. I don't think that there's much of a rate hike built into the market at the moment. I think there's probably about 25 points over the next 6 to 12 months. So some would argue, I suppose, that's maybe may not be reflective of the risks in the market at the moment. But look, I think it's fair enough. I think that we do have we had a lower inflation outcome than we were expecting, and I think that was a really good result. So rates can probably stay lower for the longer term, and I suppose that does give the Reserve Bank a lot of breathing room. It gives them time to room to move, I suppose.
So, because a lot of economists are expecting a couple of hikes through the course of the year, but you think it's more likely that we'll see less?
I think it's really dangerous to sort of predict that far out at the moment. I think, as you mentioned, we're going to get some guidance, hopefully, about the longer-term forecast for inflation and growth in Australia as a result of this meeting. So then we can go back and start to work out whether that's right or wrong. One of the things I think that we do need to bear in mind that I think the underlying tone of the RBA is hawkish. So I would tend to err on the side of higher rates. I also think that the threat of inflation is probably inflation's more likely to accelerate than decelerate. So those are things that I think that need to be factored in, and that could lead to further interest rate increases.
What are the bond markets expecting in terms of the inflation outlook?
Well, I think the bond market was a little bit surprised by this benign outcome, and so I think at the moment it's a wait and see. I think this meeting, although it won't deliver any direction in terms of short-term rates, I think it's going to deliver some significant direction to people for longer-term forecasting.
Of course, the political battle begins now over the flood levy.
Right.
This is a big talking point, just announced at the end of last week. Do you think it would have been irresponsible for the government to not make the timeline of the 2012-13 surplus? Because this, in the end, was what it was all about. It's getting the budget back to surplus. Is that an admirable kind of target? Should they be sticking with that? Or, could they have gone into more debt or done other things?
Look, I think it's admirable that they're setting fiscal targets and they're demonstrating fiscal responsibility. That's really key. And when you look at what's happening in the rest of the world, it's a pretty good example, I suppose. I think as I said before, there are these low probability events, or the Queensland flood, all these things that seem to be happening. And governments, I think, need to be flexible. I think our government in particular is in a very, very good, strong financial state. So loosening the purse strings in order to rebuild infrastructure and do other things like that is very important, I think. So I guess they've got to weigh that against the political agenda, but we're in a really sound position in terms of being able to spend and rebuild our economy.
Some are still arguing, it's a point you were raising with David as well, though, that the very sector that's going to be hit by the flood levy, and that's consumers, is the very sector that probably is struggling in the Australian economy at the moment. Do you have a view on whether it will maybe it's going to have a magnified influence because of exactly the kind of risks that you're already speaking about?
Yeah, I don't think it's a positive, and I think that people are a bit shell shocked at the moment, and whether that's because you've survived the Queensland floods or because you're finding it hard to make ends meet. So I think it probably is going to reflect in a downturn for that sort of retail activity or consumer activity. And I think also in the scheme of things, I think it's a very blunt instrument. A lot of people have given a lot of time and effort and a lot of money to the relief already, and so putting a blanket tax on everyone, I'm not certain that's the way to do it. But having said that, I don't have an alternative suggestion. It
sounds like you think there'll be a psychological impact more, because people seem to agree that in some ways it's small change for 90% of people paying maybe $1 a week, but the psychological impact is bigger.
Well, I just think that people have been through a testing time. I think with the monetary policy settings recently, or coming through the December quarter, they were starting to bite. We're seeing things like building approvals falling. We're starting to see the slowing of the economy, and through the Christmas holidays and what have you, it's generally a time when people are scratching around for a few bob. So I can't see it being positive at all.
Jim, thank you so much. We've got a couple of guests coming up, so we'll look forward to you contributing to those as well. Jim standing with me from Big Securities. In fact, coming up, we're speaking actually with Brisbane Airports Corporation about how they're rebuilding. Also later in the program, Andrew Fraser, the Queensland Treasurer, on the cost of rebuilding. Welcome back to the program. Let's take a check of the SPI again, and by this hour you'll realise we're probably facing a tough start to the day. The SPI's been off around 50 points, and experts we've been speaking to and hearing from this morning across First Business suggest that's probably a good guess as to the market action when we kick off today, given the unrest in the Middle East? As we're here in Brisbane talking about the rebuilding effort and the reconstruction effort underway and the challenges that businesses are facing, one of the major companies, of course, to speak to is Suncorp, a big player in this market and in the, at times, controversial space of insurance up here as people look at the kind of cover that's been offered by insurance companies in this state. We spoke to the Suncorp CEO, Patrick Snowball. He was talking to Kai Chow about the kind of perceptions out there about the insurance companies and what they're offering to policyholders.
After something like this, many people would think premiums are going to rocket after this one. Is that what's going to happen?
Okay, I appreciate that the immediate reaction is to look at what's going to happen to premiums in the future. Actually, at the moment, I couldn't give you the answer. What I can tell you is that the current exposure to these catastrophes is well covered by Suncorp and well protected by our relative reinsurance treaties, which kick in at different levels. In terms of premium going forward, we obviously have to look at what is the cost of our reinsurance and how does it work. But as I said, at the moment, it's really too early to tell.
It is a very competitive landscape out there for the insurance sector. Does that suggest that there could be a lid put on premium rises, perhaps even more so than perhaps costs might justify, for example, because your costs are going to go up?
I think interesting you should say that. I mean, across the whole of Australia at the moment, there is a series of events happening. And you've got to look at the whole of the Australian market and the very competitive element there. But also then look at the reverse of that, funnily enough, in Queensland, where perhaps there's not enough competition at the moment. In other words, we are the only insurer that is giving automatic flood cover. And we certainly can't afford to insure the whole of Queensland. So there is a capacity issue involved in it.
As you mentioned, you're the only one that provides that automatic flood cover. You're the dominant player here in Queensland. So how about solving the problem by sharing that data, perhaps at commercially viable rates for you, of course, but that could be a way to relieve the pressure, right?
All I can tell you is that we didn't generate the flood maps we've used ourselves. We've used data available in Australia, and we've also used data available from the local council. I guess because we live in Queensland, we know perhaps how to interpret that data a little more. But of course, that's one of the advantages of being a Queensland company. But I think there's an adequate amount of information out there. It's really how that information is interpreted that's so important.
You say that you have this advantage because you are Queensland based. That's why you're able to interpret this data better. So is it reasonable to expect your competitors to be able to do the same since they don't have the scale that you have here? They don't have that size.
I think that you have to go right back to risk appetite and analyse the risk appetite of any company. I mean, that's one of the things we've learned from the global financial crisis, that too many companies were operating out there outside their risk appetite. So if you look at it in this particular environment, it may well be outside the risk appetite of many companies to write this level of risk in this particular market. And actually that's a good thing, because you should never do something that you're uncomfortable to do. I guess just the debate going forward is going to be around the capacity, the access to information, and the appetite to underwrite. Now, perhaps the lessons learned from this particular catastrophe, particularly the one around Brisbane and Ipswich, rather than the awful incident in Toowoomba and the Lockyer Valley, is that we now have a lot more data than we had before, and it may allow people to make better decisions going forward.
And we're joined now on the program, Jim Stenning and I, by Jim Carden, who's from Brisbane Airport Corporation. Jim, thanks for coming on the program as well. Just firstly, update us on, or bring us up to speed on the kind of impact that your corporation saw from the floods.
Well, Brisbane Airport, as you know, is located at the end of the Brisbane River, so we certainly saw a lot of water coming through our area. Fortunately, though, the airport was very well planned and was pretty resilient to the rising water levels. It was touch and go for a while, but there was no effect on operations despite some of the rumours that were swirling around at the time.
So it was more of an indirect impact in terms of the flooding. What becomes a priority in that kind of situation then?
Well, information becomes the most important thing. In the midst of the flood, we actually had our busiest day on record, some few days before the flood actually peaked. So there are a lot of people who rely on the airport as their gateway into Australia and out of Australia, and when the emergency services needed to come in, the relief itself was pretty much airborne. So it was critical that the airport remained open, and for all of our stakeholders, all the way from government through to business, it was vital that they knew what their travel plans were going to be.
And in terms of the financial markets or the debt markets, which is where I sort of dwell, it's interesting. I mean, infrastructure assets have been highly sought. We've seen interest margins come in, and I think the fact that your stock or your debt in the markets sort of managed to maintain and that bid tone through the crisis, that's a testament to your disaster recovery plan. I mean,
well, it'd be nice to take credit for that, but I think there's a certain resilience in the type of infrastructure that airports represent. You've seen with previous crises, the Bali bombings, the various wars around the world, and the various hits to the tourism industry. The aviation side has proven to be quite resilient and has bounced back from those short-term hits, and we'd like to hope that this will be a similar case.
In terms of, obviously you've got a big infrastructure plans going forward. You've got a 5-year master plan. In terms of implementing that now, you're competing with obviously all the other infrastructure that needs to be rebuilt within the state and elsewhere in Australia. How challenging will that be?
Well, that's tough, and it always has been tough. We are in a very competitive space for talented people, whether it's engineers or planners in a very specific and specialised area. And we're building a runway over the next decade or so. We believe it's the first runway to be privately financed in the world. That's going to come in somewhere around $1.4 billion, and we need the best brains and the best people in Australia. And as you say, we're competing against some pretty hot prospects here in the restructure, but also in the mining resources sector and infrastructure generally. It's a very hot space.
So you can relate to the idea of capacity pressures and capacity constraints that Wayne Swan has been talking about the last couple of days.
Absolutely, and the worst thing that can happen in times like this is that you take the foot off the pedal, because in 5 or 10 years' time that infrastructure lag will catch up and bite you again, and people will be saying we should have been building. So it's a tough call to make, and the timing is very important.
I'm also interested in your contacts and what they're saying about the impact to the tourism industry. With all of our discussions, we seem to be talking short-term and long-term, but on both fronts, what are you hearing?
Well, it's probably still a little too early to tell in terms of the passenger numbers. We certainly saw an immediate hit. Rockhampton, for example, was 5% of our domestic business. Now, that airport was underwater, as your viewers would have seen. So the short-term hits are people cancelling trips. Business closed down for a while in downtown Brisbane, and that was a big hit for the airlines. Longer term, it's about confidence, and it's about getting the message back out to the marketplace, down south and internationally, that Brisbane is still a beautiful city. It's open for business, and all of our tourism destinations are just as beautiful as they were before the floods, and we've got to get that message out. So there's a collegiate effort with government, the tourism industry, the Tourism Queensland leading the charge to get a positive message back out there that it's business as usual. Brisbane is open for business, and Queensland is a lovely place to come.
So would you say that's the main responsibility of corporate Australia now, getting that message out?
I think in the longer term it is. In the short term, obviously, it's relief with the financial burden that we all have to share. Bearing in mind that we're stakeholders in the prosperity of this city and this state, then I think we're also stakeholders in its recovery. And we, as a corporation, certainly stumped up. And indeed, I had news last week that our sister airport in Amsterdam, who's not unfamiliar with the impacts of water, also donated $125,000 to the Premier's appeal here. So the message is out there internationally, and we're all banding together as an industry to get back on our feet.
How do we know when Brisbane's back on its feet? We're getting the message out there that it's getting there, but how will you know? What's that point that you're aiming towards?
Probably when the next major crisis hits, because in aviation there's always one around the corner. It's hard to tell. I guess when we're all leaving work at 5 o'clock in the afternoon and having our weekends off.
All right, so that'll be the measure. Thank you so much, Jim, for joining us.
My pleasure.
Appreciate it. Jim from Brisbane Airports Corporation. We'll take a quick break. Be back in just a moment. welcome back. We're about to speak with the Queensland Treasurer Andrew Fraser. Ahead of that, a check of the numbers where the SPI is down around that 50-point level with the unrest in the Middle East, unnerving investors and certainly sending them into safe havens, which means out of equities. We'll expect the same on our market today. Wall Street having its biggest one-day drop in many months, but of course gold was up as people looked for somewhere to hide amid the worries, and the oil price spiked more than 4% on supply worries now, or potential supply worries coming out of that part of the world. So all in all, expecting a pretty rough start to the trading week. Let's go now to the Queensland Treasurer Andrew Fraser, who joins Jim Stenning and I here in Brisbane on the banks of the river. Andrew Fraser, thank you very much for your time.
My pleasure.
We have heard in the last few days of the $1.5 billion being set aside by your government for the rebuilding effort, and the $4 billion roughly from the federal government going to Queensland, $2 billion immediately. At this point, how do you start to prioritise where that money goes?
Well, we've already started the priority effort. Obviously, this is how we fund the task that we commenced immediately that the floodwaters started to recede. So the big priority was getting schools back so that life could return to normal and that the economy could go back into its normal pattern. But obviously a big priority now is those key arteries, the key export arteries, to make sure that the state's economy gets up and moving as quickly as possible. But as you say, the federal government's advanced $2 billion, and when you have a deposit that's $2 billion, that gives you a sense of the size of the task that we have.
And are there particular projects that you start distributing the money to? How does that actually then get divvied out now?
Sure. Well, one of the things that we've done immediately is advanced $400 million to local councils, who obviously have a big task in themselves in cleaning up their own towns, their own cities, to make sure that those funds are there straight away. And as I said, the other big priority is those key export infrastructure tasks. So we've already got a major contractor on site for the Western Rail Line that runs out to the southwest, important for coal, important for agriculture in Toowoomba and beyond.
Sorry, could you just run us through the Queensland Reconstruction Authority? How does that work, and how does the filter process for prioritising projects work with that entity?
Sure. So Major General Mick Slater is the chairman of that authority, and we've appointed the state's Coordinator General, who has a range of powers open to him to fast-track processes. So that has a board that will be constituted, and obviously that will work now on cutting through the process to ensure that work is underway to restore assets. So that's all oversighted by a board. But also what we've got with that Reconstruction Authority is it will be the entity that looks to the sort of projects that might be improved and rebuilt in a different way in order to improve our resilience into the future.
Okay. You've just been through the process of trying to get the numbers together, and obviously a lot's happened since the budget for this financial year, and the mid-year budget review has obviously there have been some material differences in terms of what was originally forecast. And one of the things that the tone that we get reading that document is obviously that Queensland's very exposed to the Australian dollar. Can you sort of explain to us in what sort of in material terms what that means to the forward estimates?
Well, we've certainly had a big impact on royalties and also on the prospects for tourism as two export industries that really get driven by an Aussie dollar. The Aussie dollar's been rampant since the budget was handed down last June. So overall, both with flood impact and the Aussie dollar, you see around a $300 million write-down in royalties alone. About $100 million of that is directly attributable to the strength of the Aussie dollar, given the relationship there. But also it's really particularly impacting on tourism, which is so important in many parts of the state that haven't in fact been flood affected.
Yeah, and in terms of returning to surplus in 15-16, how concerned are you about the currency? I mean, what sort of material impact can that have? I mean, I notice in the forward estimates where the forecasts are for the Aussie dollar to weaken. What if the opposite happens?
Well, I suppose people have looked at the Aussie dollar for a number of years, and the one thing you can say about it is it's a volatile currency. And so, as most foreign exchange forecasters say, look at the price today, and that's their best forecast. But
that's right.
In reality, we've seen a lot of movement, and I think you've seen a structural move upwards. So yes, we do believe it will come back a little, but not settle back to where it was structurally perhaps 12 months ago.
That's right. So one other question I was just going to ask you about Queensland's reputation, or coal exporters in Queensland. I mean, obviously in business as a commercial enterprise, if a supplier doesn't satisfy you, then you look around. It's a heads up, if nothing else, for these buyers of our product. I mean, is there anything that the government's doing to address those issues?
Well, certainly we've seen through the flooding effort, the Newlands system continued to pump out through Abbott Point Coal Terminal, and getting infrastructure in place like we have with the Northern Missing Link gives you optionality about the ways in which to get coal to market. So we've seen a bit of resilience there built in because of infrastructure decisions taken some time ago, but it's important also to recognise here that Queensland has some of the highest quality coking coal, and so therefore ours is a premium product, and it's about securing supply, as you say.
Wayne Swan, the Treasurer, the Federal Treasurer, has also been talking about the capacity constraints actually limiting the rebuilding effort, and of course that will be focused up here in Queensland, a lot of it. Is there anything that your government is doing or can do to try and ease that pressure?
Well, certainly I expect by the end of this year, in 12 months' time, that we'll go from a very different position where the call on skills and skill shortages will start to put pressure in parts of the economy. I don't think I'd be renovating a house in Brisbane if I had a choice towards the end of this year. I think tradies will do particularly well by the time all that activity is underway. So we've got a new skills commission in place which has been constituted, as it happens, from the 1st of January, which is about driving a new industry-led model in skills formation and making sure that we're getting that skill formation and training the people that we need, because we do see a very different end to this year than we've got at the start.
So is there anything you can actually do about some of those rising costs of construction? Because we get viewers in from Sky News writing to us saying, you know, we all know where this goes, and some of them had written to us, they went through Cyclone Larry and they saw the $5,000 bill for the $100 job. It's the natural outcome of supply and demand fundamentals, of course, but is there anything that you can do to reassure people that, you know, that they're going to get the most for their dollars?
Well, as you say, markets are markets, and that's something that's going to occur. As it happens, we've seen some pretty good prices in the marketplace just in the last 12 months, which is a big change to the previous years in terms of our own procurement, our own capital works. But obviously those pressures are going to be there, and that's why training up people in order to get the skills flowing through, but also making sure we've got capacity in the industry, which is something that we have built up in this state over recent years, should ameliorate that compared to the experience post-Cyclone Larry.
I'm also interested in your projections of 1.25% growth for this year, GDP, ramping up right to 5% within a year. For you personally, what do you feel is the biggest challenge in managing what you, I think, described as that roller coaster ride that we now expect?
It certainly will be, and I think the big challenge is going to be around skill formation and skill shortages, and making sure that we control wage pressures as well, because obviously as we expect to see unemployment on the rise as the fallout from the floods flows through, but as the economy moves back in, as those big LNG projects in regional Queensland, that big investment pipeline starts to flow, as the reconstruction effort starts to flow, we've really got to keep an eye on wage growth to ensure that we don't get runaway inflation and that we don't get economic settings that are actually going to present a problem for the whole economy.
Yeah, I mean, and that's the real challenge, isn't it? Because, I mean, coming back to the forecasting, obviously that type of growth has ramifications for Australian growth, and it has ramifications for monetary policy. So in terms of those forward estimates, what's the general thinking around interest rates over the next few years?
Well, I think we're broadly of the view that interest rates will be largely benign and then move up toward the end of the year. I think that the Reserve will look through the sort of spike that you expect to see driven on the back of fruit and vegetable supply and other things in the nearer term. But certainly our task here is to make sure that, knowing that that's the likely path, that we time our projects into the market and make those adjustments to ensure that we're not adding to the dynamic that's going to be at play from a natural recovery.
What do you find, can I ask, on the inflation aspect, is the best measure of inflation when you're worried about inflationary pressures building? How are you judging that?
Well, obviously we monitor the CPI like everybody else, but we do tend to look through the volatility that you get at a state level, and so obviously monetary policy settings are a matter for the Reserve Bank, and one which is before them tomorrow, but as I indicated, I think that they can and should and will look through any potential spike and sit tight for the moment, and I think that benign setting is appropriate at this point in time.
In terms of the training and the upskilling of individuals and building a workforce to take on these tasks, I mean, logically that seems like a longer term proposition. When do you see that starting to kick in, or when do we start to see the benefits of that?
Well, we've made these changes and already implemented them, so they do flow through into the future, but these are things that we've been working on as a state for a number of years. So we have the highest number of school-based apprenticeships in Australia, in Queensland, because we recognise that the nature of our economy and the nature of the education task means that that's an appropriate way to channel skills in and to get those moving. We've changed the way that apprentice pathways so that they can front-end some of their training off-site so that they're back on site and working and utilising those skills. That was a response to the last couple of years when there was a lower level of activity. So I think we've got those settings in place which should really go to balance as far as we can, but we need to understand that the marketplace will drive a very big change here towards the end of the year, and no government can change that.
Can I ask you about the flood levy of the federal government now? Do you expect that the donations from the public to the Premier's flood appeal have to dry up from here? What are your expectations for where that goes?
I think if we look at the flood levy away from the sort of chanting and mantra politics that's been instilled in the debate so far, and for an average wage earner it's about $1.20 a week, and that goes towards rebuilding Queensland, rebuilding the infrastructure, rebuilding the vital parts of this state's economy, and remembering that for all Australians, when Queensland does well, the nation does well. We're a fifth of the nation's economy, we're a key part of the nation's exports in particular, and Australia can't afford to have Queensland on its knees. So this is important for getting the Australian economy back on track. When it comes to the levy, obviously that funds all of that. The donations are about helping out those people who've lost their homes, and I know that people see the difference there. They know that their donations are about helping out Queenslanders who've lost their family home, who do find themselves homeless, lost their possessions, and that's why we've seen such a big outpouring of generosity, and I think people will make the distinction.
What are you saying to Queenslanders about what they can be optimistic about for the future, given all the challenges that you've just set out?
Well, take a look behind you. It's a bright sunny day here in Brisbane, and I think the medium-term prospects for this state are as solid as they ever have been. We've got those big LNG projects with investment flowing through. We're going to have the reconstruction effort flowing through into the economy. So I think that we're going to have a big roller coaster, as I said, in the economy through this 12 months, and that means that we should all feel optimistic about the level of activity, the level of growth, and Queensland getting its mojo back towards the end of the year.
What happens for you now? Because we saw you through the crisis with everyone else helping to get in there and clean up, you know, with the casuals on, of course. Does it return, you know, business to normal for you, your average week? What are you doing as the Treasurer of the state that's just gone through the biggest disaster in its history?
I'm not sure that there is ever an average week in one of these jobs, but as far as it goes, obviously we've got a fairly major cyclone threat still in the state. I grew up in Proserpine, one of the towns that's had a fair bit of activity overnight. It's well and all's well there this morning, but the cyclone that's coming behind is one that we're really going to have to prepare for, because it's got the capacity to wreak damage on a part of the state that so far, thankfully, has been spared most of what's occurred. So I think this week's going to be dominated by a bit more looking at the weather chart, frankly.
So what do you do? Are you in meetings about this? Are you speaking with businesses? Are you on the phone to the local news agent? What are you doing?
Well, we've got the State Disaster Management Group, which oversights this. I've already spoken to a member of the government in North Queensland this morning about how they fared overnight, and all's well up there, which is a good thing to report this morning. A little bit of rain and a fair bit of wind, but minor damage at this point. But they're all focusing on what to do to prepare for the end of the week. That just means keeping the tape on the windows at this stage. They're pretty well prepared because they've just gone through one overnight, but that, I suspect, looks like the warm-up act.
Thank you so much, Andrew Fraser, for joining Jim and I. Appreciate your time.
No worries, thanks a lot.
Andrew Fraser with Jim Stenning and I. We'll take a quick break. We'll be back in just a moment. Welcome back to the program here in Brisbane. I'm with Jim Stenning as my guest host for the program today. I mentioned the markets just briefly, of course. We're kicking off trading just in a short time, but obviously some weakness expected given the offshore leads for us today. The SPI down around 50 points. Let's go to our next guest. Of course, you know, Jim Stenning's with me here in Brisbane this morning at Kangaroo Point, but we're joined by Mark Bailey, who's from Equasia and in our Sydney studio without me. Mark, good to see you and to speak to you this morning. We chatted just briefly with Jim earlier about Egypt and the heightened risk aversion coming out of that now. How is this going to play out? What are you expecting?
Good morning, Brooke. I think that's exactly right. You've seen, obviously, the situation in Egypt and other Middle Eastern countries as well kind of really hit the radar, both in their countries and also on the economic stock exchanges of the world. We saw trading in the Middle East countries on Sunday, which is the first start of their trading over the week, and some of their indices were down, over 6%, closing between 4.5 and down 2% in various stock markets there. Obviously, there was a huge concern about the oil situation as well, whether the Suez Canal would close. I mean, reading between the lines from what I can gather, not being an expert, it looks like that's unlikely to happen unless they basically sink a ship in the middle of the channel. The authorities that run the Suez Canal have said, I think, 37 ships passed on Sunday, and that was similar to a number on the Saturday, which was about 45. So a lot of, obviously, cargo goes through the Suez Canal, and there was fear on Friday, which is why you saw a fairly severe spike in the oil price, that some of the West Texas Intermediate shipments would have actually been delayed or prevented from finding their final destination, but that concern appears to be, I think, somewhat limited. I think as well you're going to see a bit more concern in terms of the inflation outlook. Commodity prices kind of moving away from that situation. You've obviously got the Ivory Coast election, which is still in a bit of turmoil, and they're obviously the world's largest supplier of cocoa, so that obviously feeds in again into cost import prices for a lot of commodities and a lot of consumer goods, and that again is going to put a lot of pressure on inflation going forward. And I think you're right, kind of looking forward, I think this week is going to be very much risk off. You saw that on Friday. Investors were very skittish there. They were very keen to take risk and money off the table, bank a few profits for the year, and I think that just illustrates how the overbought situation was in a lot of asset classes that so far this year, where we've had a very good run for December and January, and I think we're achieving some levels where it's a bit of a kind of nosebleed territory, especially for equities, and there's still a lot of risks out there, which I think the market is starting to really come to grips with.
Are you saying it comes back ultimately to inflationary expectations? So what's the biggest worry then for the markets, or is it contagion? Or? Well,
I mean, you're right. I mean, whether it's contagion, I mean, whenever we have a situation, whether it's Greece or going back to the Far East crisis, the Thailand, everyone's worried about whether it's actually contained or whether contagion will spread, and it always spreads how you least expect it. And I think, although this situation at the moment appears to be contained, I'm always very cautious of that, because it always kind of feeds through, some country will have exposure to Egypt, or some bank will in Europe, and then it kind of it's a domino effect. But I think the main takeaway point from the trading that I saw on Friday is that the risk appetite and the conviction that investors hold is pretty limited, and they were very willing to take risk and money off the table, and that's why you saw the pullback on Wall Street on what appeared to be a fairly contained political process in Egypt. So that was my main takeaway, that I think that the markets are generally at the moment overbought, and I think we're likely to see a fairly dramatic pullback in the near term, and maybe this provides a catalyst where investors just say, okay, we've had our profits for the year, we've had a good run, let's just take a bit of risk off the table and let's see how things pan out, not just in Egypt but also in Europe and the Eurozone, and also with the situation in the States, the debt ceiling, the deficit there, the states, the municipalities as well. So I think it's just kind of a reassessment and just kind of bank a bit of profit for the year as we've seen so far.
Mark, we've seen, as a result of Friday night, we've seen a rally in the US Treasuries, a flight to quality. We've seen weakness in equity markets. How do you see this sort of translating into, say, the investment-grade credit indices around the globe?
Jim, I mean, I guess they generally tend to track the equity indices, and I think you will see a pullback in those indices. In terms of their relative performance, the US has been performing significantly better than the European indices, as I'm sure you're aware. Part of that is to do with the situation in Europe and the fact that the banks in Europe are always tied and kind of woven into the fabric of the sovereign debt crisis there, and the perception is that the US is likely to pull out of recession sooner than the Eurozone, and also maybe their banks aren't as heavily reliant or dependent on the situation in Europe. But I think you're still going to see a pullback in the credit indices. I think investors that I speak to are still pretty cautious on the fixed income side of things as well. And I think one of the key factors as well going forward, and there's an article that will be in the FT on Monday that will hit people's kind of hands on Monday morning trading in the UK, is the fact that there's going to be some kind of insurance capital adequacy ratios where they're going to start to assign the amount of capital to each asset class, whether it's equities, emerging market equities, fixed income, and that might push people more into emerging market and sovereign debts and away from corporate debt, and also out of equities as well. So I think the implications of that are that it's due to be up and running by January 2013. Some of the larger fund managers have already apparently started to shift positions to account for that. So I think that's going to be another interesting factor this week in terms of on top of the overlay from the Middle East as well.
Okay, and as far as the US goes, I mean, we're starting to see some encouraging or mildly encouraging statistics out of the US. In terms of looking forward 6 months when QE2's complete and this issuance continues unabated, what's your thinking about the long-term rating prospects for the US?
I mean, that's a very good question, Jim. I mean, you're right. We had some good economic GDP printout in the US on Friday, 3.2%, which is fairly good going by anybody's standard. But the fear is that you're going to see some kind of pullback once QE starts to be pulled from the market, and what's that actually going to mean for the US economy going forward. I think in terms of their rating, I mean, you've already seen the rating agencies start to comment about that and say that unless they start to, reduce the deficit, then maybe a negative outlook is likely. And I think, in all honesty, if the country with those statistics didn't have the reserve currency of the world, then you wouldn't see it as a AAA rating. But the US has got that huge advantage that it's got the reserve currency of the world, and that's going to help its rating. And I think the rating agencies have said that. But within 6 months, a year, I would not be surprised to see a negative outlook on the US AAA rating by either S&P or Moody's. I'm not saying that's going to happen, but I don't think it should shock the market. I mean, we've already seen the rhetoric from the rating agencies. That's potential. I mean, they're talking about two years down the line, but as we all know, we all think the rating agencies do rate for the longer term. But if there's a shock or some other kind of action in the short term, then they won't hesitate to do something to the rating.
Mark Bailey, thank you so much for your time from Equasia today in Sydney. Appreciate that. And my guest host for today's program, Jim Stenning, huge thanks to him. And we'll be back with Market Express.